Thank you very much for joining us this evening for this webinar. When we set up this call 2 days back, it was a different mood in the market. And today, the mood might have at least outwardly changed a bit, but that's the way markets are. And that's precisely the reason why we wanted to talk to you and try to give you some insights, at least what we can see as to what's happening and what can be expected, and try to make some sense out of what can be seen as a rather confusing market to many people. So, this is the risk of risk presented by our markets. You keep a title like blood on the street, and 2 days back people may ask, where's the blood? Happens, and I think there is still a lot that we want to share with you. So without taking too much time, I'll introduce our team who is there here to talk to you, and of course take your questions also subsequently. So we have Vinay Pahadia, our Chief Investment Officer. Of course, many of you are familiar with him. We have Hardik Bora, our fund manager on the equity side, senior fund manager, and we have the other senior fund manager, Sanjay Bembalkar. I'm Pradeep Kumar, CEO of Union AMC, and I also have my colleague Saurabh Jain, who is our Chief Marketing Officer. So with that, I would request Vinay to share his thoughts, and later on we can take the questions. Some questions have already come, so we'll try to answer that. But any other questions that you may have, please post it in the chat, and we will try to address them. Thank you. Over to you, Vinay.
Hello, everyone. Welcome to this special webinar by Union AMC. Thank you, Pradeep, for that great introduction. I hope my presentation is visible.
Yeah.
Just give me 1 minute. So what we are going to do is, the format of this webinar is going to be very interactive. The objective of this webinar is to come to you at a time when there is turbulence in the market, there is a lot of confusion, and people are just worried about what to do, what not to do. Your clients may be asking for a lot of hand-holding guidance, and this is exactly the time when our clients need us. So I think the objective of this webinar is to help you answer those queries, help you take informed decisions. So this market update is going to be short. We will focus more on the questions and answers to help our participants answering a lot of their doubts. So before we broadly talk about valuations, I think what is very important to understand is Union Mutual Fund has a very unique fair value approach in judging the market valuations. We have put out a lot of research papers highlighting how this approach is very different than the commonly used price earnings multiple or price to book multiple, which is very popular in judging valuation. So the fair value approach actually is mathematically consistent. It is proven to be very, very clear, and it doesn't get impacted by changes in the underlying constituents, which are the various problems which the other valuation measures take in. So I hope the slide is visible. Just give me 1 minute. Just give me 1 minute. So see, till the time we get the slides, the idea of this approach was to ensure that we remove the inconsistencies associated with with the P multiple based approach. Um, in the meanwhile, if I can ask any of my team members to share the presentation, um,
I'll do
there
that.
seems to be some challenge at my end. Um, so what we discovered is that our approach is fairly consistent over periods of time, and it has helped us to understand what is the underlying valuation, and has helped us to take relevant decisions. So what is this fair value dependent on? This fair value is very much dependent on the underlying GDP growth. It's dependent on how the underlying nominal GDP is growing at. So as you can see, we have tried to do a back testing of this entire approach. We have tried to calculate the fair value of Nifty and looked at how does this growth or how does the fair value change in response to the nominal GDP. So as you can see, this is the blue line, which is the nominal GDP, and the orange line, which is the fair value, are very much tightly correlated. There was a time in fiscal year 20 when the GDP slightly slowed down, but fair value went up. That was because the government of India announced a very big tax cut for corporate India, which resulted in fair values going up despite some slowdown. Excluding that period, actually the entire journey of fair value has been pretty consistent with nominal GDP. Uh, for some of those who would want to know what is this nominal GDP, nominal GDP is nothing but an addition of real GDP and inflation. So if inflation goes up, the nominal GDP also goes up, real GDP remaining the same. So that's something which is very closely related with the fair value growth. You can go to the next slide. Now, this fair value is very much responsible for the returns which we get as an investor. As you can see, a lot of people focus on expected EPS, profits of Nifty or the benchmark, the Nifty P multiple, the Nifty EPS growth. I think clearly this graph tells you that markets are very, very tightly correlated with fair value. They move around the fair value pretty consistently, and clearly there is very, very limited relation between the calculated profits for the benchmark. Remember, we have given some big research notes, research papers highlighting how there is a arithmetical problem in calculating the profits for the benchmark, which doesn't help you take a proper judgment on valuation, and hence clearly if you look at the historical data as well, markets have moved in line with the fair value. In FY20, that was the start of the pandemic, the markets had fallen significantly below the fair value. At that point of time, we came out and we had given an update. We had thumped the table and said that this is a great buying opportunity. Markets are available at a deep discount to their fair value. A lot of people had questions that what will be the impact on fair value? What is the impact of the pandemic? All of that was unknown. But what was known, what is in our hands at that point of time, was this understanding of the discount to fair value. There was a complete U-turn in the next year. So somewhere in FY21, markets reached at a significant premium to the fair value. And we had come out with an additional update talking about how the valuations are at a premium. Now, we are once again coming to you and highlighting that markets are now trading in line with their current fair value, which means markets are once again reasonably valued. Historically, we had said that markets have borrowed some returns from the future. Now, clearly that borrowing has completely been removed, and now the returns which an investor can expect from markets should be in line with the growth in fair value, because we are buying the markets at fair values. We can go to the next slide, Hardik. So broadly, I think if we want to summarize our views on the market, the outlook, it would be summarized as follows. What are the key headwinds, the key problems or negatives for Indian equities? I think these are some of the big ones. At the top of our concerns list is unwinding of easy monetary policies across the globe, including India. All of this includes all the measures like quantitative easing, like lower interest rates, etc., which have helped help the markets with extremely low cost of equity. We think this could result higher interest rates in India, and it could result in reduction in liquidity, because unwinding of these easy monetary policies is likely to reverse the previously low interest rates and abundant liquidity scenario. So we think this is the biggest risk for any investor investing in equity or any other asset class, because interest rates act like gravity on assets. The second headwind includes a lot of unknown and unintended consequences of Russian invasion of Ukraine. So at this point of time, we some of the known consequences have been rising commodity prices. Uh, uh, some of the known consequences have been supply chain disruptions. Of course, there is a humanitarian problem, but there are a lot of unintended consequences or second order or third order consequences, which at this point of time we are not able to understand, identify, but we will come to know over a period of time, which could be forming a headwind for equities. The third big headwind is of course the rising input cost inflation. This could hurt gross margins for corporate India, and companies who try to pass on input input cost increases to their customers, they could see an impact on their volume growth. So, for example, sectors like paints are seeing a significant inflation in their costs, and the cost and this is likely to result in significant increase in finished product prices, which is likely to hurt volume growth. Finally, the last headwind, which we think could impact Indian equities, would be slower than expected pickup in private consumption and GDP growth. Once again, this is a consequence of the rising geopolitical risks which we are facing today. Post the pandemic, there was an expectation that there will be revenge travel, there would be revenge spending, etc. But now, once again, there seems to be some cautiousness in the air, and this could have some impact on private consumption and GDP growth. Of course, the inflationary environment is adding fuel to fire. So we have discussed some of the challenges which markets can face. I think these are very well known. I mean, a lot of people talk about these challenges in bearish or times when markets don't do well. But let's talk about some of the positives. Why do we think one should invest in the markets? The biggest and the unique and the most important reason, number one, is reasonable valuations. So we think now markets are at reasonable valuations, and equities as an asset can compound the fair value at a reasonably good pace. If you look at the interest rates and the potential returns across assets, you would notice that we are in an extremely low interest rate environment. And even if we factor in some increase in interest rates in the next 1 year, still the potential return for investors could be not very high. However, if one looks at equities and the underlying corporates, the fair values are compounding at double-digit pace. So we think that now, with reasonable valuations on our side, equities could deliver significantly better returns compared to most other asset classes over the next 3 to 5 year period. Please remember, equity returns have to be looked at from a longer term perspective. When we mean longer term, it means at least a 3-year time horizon. So over a 3-year to 5-year time horizon, we think equities would definitely give much better returns if we invest in the markets at the current valuations. Some of the other tailwinds for Indian equities, of course, include improved capacity utilizations. Over the last 2-3 years, corporate India has not yet added anything to their capacities. So whatever volume growth we have seen in the last 2-3 years has resulted in significant increase in capacity utilization, and hence a lot of companies are indicating clearly that they would now start spending towards capital expenditure, and this could result in a multiplier effect. So that's an important tailwind. And of course, we should not forget the other important tailwinds like low corporate taxes, government stimulus like the PLI scheme, and some of the other schemes which the government keeps coming out with. These keep on adding to fair values of uh, individual companies. So, as a fund house, if one were to summarize, what's our overall view? We are optimistic about equities. As a fund house, we prefer tactically at this point of time, we prefer large caps over mid and small caps. Remember, these are tactical allocations depending on valuations and depending on the macro environment. And once again, tactically, we are overweight sectors like financials, telecom, consumer discretionary, and industrials. And we are underweight sectors like materials, utilities, and information technology sector. And now we recommend equity products as preferred means of investment in the current market environment. Remember, friends, we have been talking about asset allocation products as the preferred means of investment since the last 1 year. That is now changing, and we are now saying that you can start investing in equity products as a preferred means of investment in the current market environment, because valuations are now in our favor, and we think fair values will continue to compound at a reasonably good pace, and hence we are much more confident about markets now than we were about a year back. With that, I will stop and hand over to Saurabh for starting the Q&A.
Thank you, Vinay, and thank you, Pradeep, for filling it in for the introduction. I hope I'm audible now.
You are,
Thanks.
Saurabh.
Yeah. So, Vinay, since we also have Sanjay and Hardik on the call, I'll be posing questions at random to three of you. Is that okay?
Sure. All of us are ready.
Okay. Yeah. So the first question is Mr. Sandeep Bushetty from Pune. After so much volatility in the market, what is our view on the interest rate hike from the federal banks in US and also in India in the coming months? There are three questions. Should I say one after another, or you want to take it first?
So I think I'll take it first, and then you can decide who answers.
Yeah.
So as far as interest rate is concerned, I think we have been highlighting that there are certain ill effects of the quantitative easing strategy adopted by major central banks across the globe. So we have seen most of the central banks expand their balance sheets, which simply means there has been excess liquidity in the global markets. Also, the interest rates are exceptionally low. Both these measures ultimately lead to more money than goods and services, which in classic monetary terms means it will lead to inflation, and which is exactly what we are seeing now. So even before the Russian invasion of Ukraine, we were seeing significant inflationary uh, push in developed world as well as in developing markets like India, and this is precisely the reason why we are saying that interest rates are expected to rise, and liquidity is going to reduce both in developed world and in India. So yes, we continue to expect interest rates to rise. We expect the interest rates to harden year from. and we are expecting liquidity also to start gradually reducing from the global markets.
Thanks, Vinay. Sanjay, the next question is for you. What's our view on dollar rupee movement, and also the view on huge FIS outflow, which has been happening for last 1 year? In fact, there's a follow-up question from Mr. Mata Prasad Pandey from Mumbai, that till now the DIs have been buying in last 1 year and FIs were selling. Is there a chance that DI also starts selling in the coming year? And will it have a huge impact on the market? So I've combined two questions. First is rupee dollar movement, our view. Second is view on the FI outflow. And in next 1 year, how do we see the DI flows happening in the market?
Sure. Thanks. On the rupee dollar movement first, if you look at Indian rupee has depreciated a bit, and it is also a function of global flows and overall interest rate regime, which is changing globally. We believe that interest in Indian rupees depreciation is kind of a sustainable. So rupee has depreciated in recent past as well, and that continues to be a sustainable move in Indian rupee as such. There are certain sectors which are beneficiary of this. So export-oriented sectors like IT, pharma are clearly beneficiary of this rupee movement as such. Whereas other sectors which are import dependent as such, they will be having some kind of hit. So that is a brief view on the rupee depreciation as such. We believe that this is sustainable. Even if you look at from longer term perspective, rupee has depreciated over long term horizon, and we believe there is no structural change to believe otherwise. So rupee depreciation looks to be sustainable in nature. On the FII flow and its impact on the overall Indian market as such, if you look at from CY 19 to CY 21, there was a huge FII inflow which happened in India. If you look at from global angle, India continues to be a very attractive market from equity investors' perspective because of the growth which India is likely to have, and also the demographic dividend which India has, which led to a lot of economic growth over a period of time. So India continues to be an attractive market for FIs, and that's why we have seen from FY19 to FY21 almost $40 billion of inflow has happened. If you look at last 6 months, I agree with you that for last 6 months, there is a continuous outflow from FI angle, and almost $10 billion have been taken out by FIs in past 2 months. However, we have to put this in context of what inflow had happened in Indian markets, and we believe still FIs are quite aggressive or quite invested in Indian market as such. On the domestic flows are dependent on the SIP from the mutual fund angle, at least from the SIP flows as well as the lump sum flows. And as long as investors continue to invest, I believe definitely DIs will have enough ammunition in their kitty to provide flows into the market.
Thanks, Sanjay. Hadil, the next question is for you, which is on the geopolitical risk which is going on Russia and Ukraine war. There are two questions, one from Mr. Kathiwala from Pune, and second is from Mr. Babu from Tirupati. The question is, with the current Russia-Ukraine war, what are the implications on the Indian economy, and which sectors will be impacted the most, and which sectors will be actually benefited from the Russia-Ukraine war? From market perspective, Hardik, over to you.
Yeah, so first of all, this is a question which deals with the unknown in a way, because one doesn't know exactly how much can the situation worsen. Currently, it is a conflict between two nations. There is an economic conflict in a way going on between other nations as well, but directly there are two nations involved in this. So as of now, what we are hearing companies talk about, what we are generally listening to people, current economic impact is not yet felt for Indian companies who are basically supplying to these countries, not yet is. But however, of course, if you ask me where are the red flags are in those companies where there is potential exposure. So these companies are supplying to Russian or CIS nations, and any business over there ideally will have some impact in the near term till the time this conflict remains in force. So that is a direct impact that everybody is seeing. The other direct impact, of course, is the impact of volatility on commodities. So we've seen that many commodities have seen a spike in their prices. So certain base metals, crude, we've already seen crossing more than 120 a few days ago dollars a barrel, and now around 110. So this has a positive and negative impact on a lot of companies. I would say there are very few companies which get positively affected as of now. But if I was to still name out a few, export-oriented companies get positively affected because the rupee depreciation helps them realize better earnings on their dollar that they earn. So that is on the margin beneficial for sectors like IT and pharma. Crude spike helps upstream companies. So to that extent, someone like a company which is into oil exploration realizes better. It also indirectly helps some companies which are selling in oil exporting countries, because those countries' economies on the margin gets a little better positioned. But if you ask me, more than the positives, we are seeing the negative impacts, because everybody gets affected, almost everybody gets affected by the inflationary costs in India. So the consumer level inflation is going to spike. That will have an impact on demand if it sustains for a long period of time. We also see that the operation cost for many companies increases because logistic and power costs are going up. So we are seeing that will be a broader impact. So net, the negative impact on the corporate India is higher than the positive impact in the short term. So that's how we are looking at the overall situation playing out. But I would want to quickly add to this that just like in March 2020, when everybody was asking us why are we confident that the impact on fair value is limited and why we should be overweight in equity, we try to tell everybody that a 1 year impact or a half a year impact on the earnings of a very long life asset like equity is very little. So the fair value of equity get affected very, very minimally because of, let's say, 1 year of impact on earnings. So all this impact that we are talking about, this only has a very short life. The fair values of businesses, which are long-term assets, as we are talking about, the companies that are listed in equity markets, they don't see too much of an impact on their fair value in the longer run. So we have to tactically position ourselves, of course, what might happen in the short term, but that is limited. So to summarize, impact is going to be negative more than it is positive. Positive sectors are IT, pharma, export-oriented sectors, and oil or upstream companies. And at the same time, whatever the impact may be, even negative, is expected to be short-lived on the fair values. So that is the reason also why we are coming up with this update. That's what I can add on this part.
Thanks, Adik. Vinay, the next question is from Mr. Ashok Sinha from Patna. And he wants to know the impact on the market because of the election outcome. And also there are like many distributors and many investors who believe, or who, because we are all reading newspaper and seeing the correlation between the election outcome and the market. So in your view, how are elections and the market outcomes are related?
Yeah, Saurabh, so that's a good question, I think, because generally we are seeing heightened levels of volatility during times of election results or such events. While I do not want to be political, but the key thing which I want to highlight is that from a purely markets perspective, continuity is always a good thing. So markets do not like surprises. So if there is a regime and there is no change in that regime, or if there is an expectation and that expectation is fulfilled, I think then the markets move on. There is no problem, and the markets like that. So I think that is our view, that generally elections till the time if they do not spring in a surprise, it is business as usual, and I think that's happened even today. So we do not think so that it will have any material impact on the market. And the reason why elections or any such things, especially the big general elections for the country, is important, and we have tried to highlight that, is because a country is like a company which is run by a management, right? So in our stock selection slides, we have been highlighting in our investment process, we will like to buy good quality companies run by good managements at reasonable valuations. If you consider India, the entire Indian country as a stock, the entire Indian stock market as one single stock, we know that what is the business, the underlying business. It's a good quality developing nation. We talked about we want to buy a good management. Who is a good management? A good management is a political leader who wants to ensure that the return on capital is stronger, the underlying entity grows faster, which is what is happening. So India's economic growth, despite all challenges, has been reasonably robust. And finally, we want to buy a company at reasonable valuations. And this is exactly what is happening now. We are talking and doing this webinar because, of course, India is now starting to trade at reasonable valuations. And I think that's what the entire situation is all about. So this elections only confirms that the management is going to remain and continue with the company.
Thanks, Vinay. Sanjay, the next question is, on the commodity prices, how much impact will it have on the market valuations, the rising commodity prices? And also, if you can give a view on gold and silver.
If you look at equity as an asset class and individual companies as the underlying assets, what we as an investor we get is the ultimate discounted cash flow which these companies are likely to make over a period of time. That is how we tend to look at equity as an investor in the equity markets as such. If you look at the implication of this raw material inflation, what happens is that companies which have pricing power, they are able to pass on this commodity price inflation to the consumers because of the modes which they have, because of the brands which they have created over a period of time, and that results into slower demand over a period of time because the income of the investors may not be growing at the same pace as such. So that is one implication of this raw material price inflation, that demand may slow down. On the other side, companies which are not able to pass on this price hike, where these raw material price hits the profitability of the companies itself, what happens over there is that profitability of the company deteriorates for the time this raw material inflation is seen. In either of the cases, either demand deteriorates or the profitability deteriorates. In both ways, it is slightly negative from the economic power of the company's perspective. And that's why this raw material inflation as such affects all broad companies, all broad set of sectors which we cover and which we invest in. And that is the likely impact of this raw material inflation on the economic power of companies as such. As a stock selection or in our investment process, we tend to invest in the quality companies which tend to have this pricing power, which have over a period of time have proven track record to pass on these price increases as such. And that's why the stock selection would be the key as well when we are dealing with the high commodity inflation time frame when we are investing. On the commodity prices as such, if you look at commodity prices are in a way, commodities are slightly peculiar in nature. So as I was mentioning, that when prices go very high, either demand get distracted, or which leads to price correcting themselves, or supply side reacts, that companies which, for example, in case of oil, companies which would have thought that at $80-90 of oil, taking the oil out of deep sea may not be viable. Now, because of higher oil prices, they may tend to revive those projects, and supply side also reacts to this situation, leading to commodity price deflation over a period of time. And that's why we believe that this commodity price inflation, which is there, is not a very sustainable in nature. It will rectify itself over a period of time. That is the main view on the commodity prices as such. So we believe that this is a short-time glut, which may be, which we'll have to go through, and over a period of time, it will rectify itself. On the gold and silver, these are the bullion commodities which are also getting affected by the decisions which are taken by the global central banks as such. On the other side, we have higher interest rate which is going to increase over a period of time, and there is an uncertainty because of the geopolitical risk which Hardeep was also mentioning, that Russia-Ukraine war, what will happen over a period of time. These are unknowns. And during such period of time, typically investors tend to do risk aversion, and investors tend to go on the extremes in either cases, on the risk taking as well as on the risk aversion side. And when the risk aversion typically happens, people tend to back gold and silver as such. So these, in such period of time, typically which are dotted by geopolitical and macro events, we have historically seen that such kind of periods are positive. They positively impact the prices of gold and silver.
Thank you, Sanjay. Hardik, the next question is from Mr. Lakshmi Narayan Kumar from Chennai. So his question is that in last 2 years, the growth in profitability were mainly because of low cost and low interest. But now things are reversing. Interest rates are looking to go up, and even the cost is moving up. What will be the impact on the EPS projections? Hardik, over to you.
So of course, EPS projections will take a lot of will see a lot of volatility in this particular period. As it rightly has been indicated, that costs have been lower for multiple reasons. Some of those costs will of course come back. There is also pressure on gross margins, so the raw material cost also has gone up. The other cost, which I think is being highlighted, is that we've seen that movement of people actually reduced. Marketing and all these activity which are now taking over, webinars were done face to face. This all has seen a reduction in cost, and some of those costs are going back. Traveling cost is going back, marketing costs are going back up to their normal levels, and that's why the profitability will take an impact. Now, in terms of projections, see, a lot of this was already indicated by the corporate India. So any company which benefited materially during the pandemic because of all these benefits that I spoke about, they did not say that all of this will last forever. They indicated this is only a short-term phenomenon, and going forward, advertisement and marketing spends will come back to normalcy. So projections, simply because of these costs coming back, is not going to face any challenge. The challenge will come because of these unexpected rise in commodity prices that have actually taken place over the last 6 months. Not just due to this recent geopolitical tension that we're looking at. Even before this, there was a power crisis that took place in the winter of 2021. Many commodity prices, power cost had gone up, and that problem was indicated before then also. So those costs are something that have only unexpectedly remained elevated. And to that extent, as Sanjay Bhai has indicated, that these situations will normalize. So what will happen, if I was to say, is FY23 will take an impact. Most probably scenario is that people will, the overall street will downgrade its estimates for FY23. But FY24, if the expectation is for things to go back to normal, the profits won't really change that much. And that is why, while whatever the change in profitability is, we as an AMC have always asked investors to focus on fair value, not on profits, because profits in the short term can fluctuate for reasons that are beyond the control of companies and governments. But the fair values are something that are created by actions that companies and managements have taken over the years and has formed a company into what it is today. And as we indicated, that the fair value impact is going to be limited. So if I was to just give a quick analogy, let's say if you have a real estate apartment somewhere which you are given on rent, and if someone has not given you 6 months of rent because he is finding it difficult, is a challenge, is promising to, however, go back to normalcy from the next year onwards, your overall price of the real estate is not going to fall because that person hasn't paid you just 6 months of rent. It's a difficult situation, but things are going to be normal. If the apartment was worth 1 crore and you were earning about 3 lakhs of rent every year, if this year you earn 1.5 lakhs, you don't reduce the property value by half. You just take in estimation, there is not going to be any change because the life of the real estate is very long. Similarly, as I said, the life of the businesses that we are tracking that are available for investments are also long, especially the companies that we identify in our fund house universe are companies with very strong quality. So yes, EPS forecast might be subject to volatility, especially in this financial year 23. FY24 expectation is not supposed to, the profits are not supposed to be so much affected by what is going on right now. Hence, will the stock price really react? In the short term, yes, but in the long run, we have always seen that prices move in line with the fair value, which are not expected to see too much of an impact because of these events. So that's the point I would want to make.
Thanks, Hardik. When we have got a lot of questions on the asset allocation in the given environment. So I'll not read out all the questions, but the basic premise of the question is that if the investor distributor partners wants to know if the client wants to do fresh allocation, given the current valuation of the market, what is the best way to enter and what kind of category of schemes that client should be entering in with a 3-year and 5-year horizon? And the mode of investment, should we be putting everything in one go, doing STP, and for what tenure?
Yeah, that's a good question. I think generally people are confronted with these challenges. We generally have three different sets of answers when we are confronted with three different sets of valuations for markets. So first phase is when markets are significantly overvalued. Second phase is when markets are reasonably valued, and third is when markets are undervalued. So generally, when markets are trading at a premium valuations, we recommend investors to take a SIP route and generally spread their investments over a longer period of time. When markets are undervalued, we recommend a very significant increase in their lump sum investments. And when markets are reasonably valued, as they are today, we recommend them to start their lump sum investments in equity. Yes, if you are doing your SIPs, you can fasten your SIPs. So for example, if you or SIPs or STPs, if you are doing your STPs, let's say over a 12-month period, you should reduce that tenure to from 12 months to 6 months. If you are doing an STP over a 6-month period, you should reduce it to 3 months duration. And the reason for that is now that the more investments made during these times when markets are reasonably valued, the better the potential returns over the next 3 to 5 year period. Simply because, as I said, returns will be in line with the growth in fair value. So I think the way we look at it is, yes, this is a good time to start lump sum, but don't put everything in one go. Start with a smaller lump sum and wait for it could be a buy on dips sort of a strategy. But yeah, start your lump sums. As far as which category of funds to invest in, once again, when markets were trading at a premium, we have, so for example, over the last 1 year, we have been encouraging investors to take the asset allocation route. So we have been recommending asset allocation products. But when markets are undervalued or when markets are reasonably valued, which is what the case is today, we recommend that investors should come in pure equity products. Now, within equity products, whether you should buy large cap, mid cap, small cap, flexi cap, large and mid focus, I think these are different categories for different set of investors, which I'm sure the advisor is much more qualified to construct a portfolio for his clients than we can, because one size doesn't fit all. But but as a general theme, we think pure equity products are looking good for investment at this point of time. And in fact, I just want to add that we as an organization have been extremely disciplined in attracting investor flows. So for example, we have not launched any new NFOs in the last 1 or 1.5 years, because we have been very clear that markets were trading at premium valuations and potentially investors may not make that kind of a money. So yeah, I think this was a clear signal. And now, since the markets are reasonably valued, we are once again highlighting that this is a good time to start investing in pure equity products.
Yeah, if I may just add a point here, while every category is good and is being managed in a true to label fashion, just remember what Vinay mentioned earlier in his conversation, that practically currently we are more inclined towards large cap compared to mid and small cap. But that is something that depends purely on the valuation at that particular point of time. So if you're asking us today, yeah, we think there is greater value in large cap compared to mid and small cap.
Thanks, Pradeep. And if I may add that it's a tactical call once again, based on the current valuation. So if tomorrow the large cap rallies a lot and mid cap, small cap doesn't rally, then the position can reverse, and which is truly reflected in our flexi cap fund, which is a very dynamically cap allocation fund. So if you look at last 2.5, 3 years, there has been a very dynamic allocation to the large cap, mid cap, and small cap over there. Hardik, the next round of questions are on BAF, and I'll just give you the summary of the questions because there are many questions on BAF. So a lot of people are wondering why they've been at 30% in the last 1 year. And do we need to relook at the model or change the model, get it like an investment outlook, process to work on the model? And are we conservative, extra conservative on BAF? So those kind of questions, because last 1 year BAF has been static at 30%. And if you can throw some highlight how BAF is managed, and if you also can give a perspective of what happened in 2020. Over to you,
Sure.
Hardik.
Thank you. No, it's a good question, and I think there are two parts to it. One is why it's where it is and has been for this period, and what is there a scope for improvement? So I'll stick the second part first. See, there's always a scope for improvement in any endeavor that is so complex, and we are constantly approaching this product and this category with that lens. So there have been improvements in the model. We have tweaked. We have actually tried different things at different points of time in the backtesting phase to see if something can happen or not. So what you are seeing is an end product, but that has basically gone through a lot of tests in the background, and different things have been applied, which I cannot, of course, disclose in detail over here. But there are many different alterations, different iterations that we have tried and come out with the product which we feel has given the best return on a risk-adjusted basis. So the objective of the product, and hence, what has happened in the last 1 year is important to highlight here. See, the objective over here is not to give the highest return possible in a dynamically managed category. The idea is to protect the investor's wealth when the market seems to be in an expensive zone, and try to participate when the market appear very attractive in such a way that the wealth can grow with least volatility that is possible. We have the model to that extent has done exactly that since its inception, and in our backtesting has also shown that. So since inception also it has done exactly the same thing. This, unfortunately, this thing to play out and this particular benefit to start reflecting in outcome, it cannot be judged over a period of 1 year, because you will have to witness multiple cycles for this strategy to really show its benefit. So for example, we had to see a very volatile 2020 when the market crashed so abruptly, and the model, because of its fair value based approach in nature, increased the allocation to the highest extent, one of the fastest in the industry, and remained for the longest at 80%. So from March 2020 to end of September, we were at the highest possible allocation as per our SID. And this is the point where I'm trying to make, that it did benefit to a great extent when the volatility was high, and then true to its nature, when the markets were expensive, it has remained underweight. So as you could see in that slide which we showed you, markets for the whole of financial year 22 have remained at a very elevated level. Somewhere in the beginning of FY20, end of FY21, that is by March 2021 itself, the markets had gone above their fair value. The Nifty was trading at a premium to its fair value. And hence, for that last 1 year, the model has had an allocation lower to, at least lower level, because as I said, markets were expensive. Now, as I said, this is a valuation based methodology. We are not pro-cyclical in approach. We are not momentum based in approach. We pay more attention to the market's fair value. We have observed in the past that stock market returns have been very closely linked to the fair value, and hence a model which is tracking that has given the highest return is what we have observed on a risk adjusted basis. So such models will typically benefit a lot when the markets are correcting, because they will be able to capture the weakness in the market appropriately. But at the same time, our markets in the exuberant phase where markets were very exuberant for the whole of calendar year 2021, the financial year 22, that is, the model would definitely indicate that this exuberance is overdone and would expect a correction. So that's what has happened. So this is a short-term fluctuation in the market, and hence a very sort of an unfair point of range of period over which you should appraise the strength of such a allocation or a portfolio management strategy. Over the long run, the portfolio has been above average compared to its peers. It has also given returns with least volatility compared to, let's say, the broader market. So from that perspective, we have observed that the whole strategy and the model has carried out its job pretty well. We are, of course, constantly evaluating options to improve upon what we already have. But currently, so far, we are satisfied with what the model is doing, and it's performing in line with the expectation. Just a point, sorry, to add here, because I think this will also be coming at some point. If markets remain where they are, the allocation of the model will go somewhere between 40 to 45%. So assuming that today's close remains where it is for another month or so, either it time corrects or if there is some sort of a volatility, but it remains where it is, then in next 30 days, we will see the allocation going up to around 40-45%. So the model has already started taking the cheapness in the market that has played out over the last few days. The fact that the markets have come now closer to their fair value, it has started taking that into its consideration and has started recommending an increase in allocation. So we will be seeing that number going up as well. Since it's a related point, I thought I'll highlight that.
Thanks, Adik, for covering the BAF. Pradeep, can I take the next question for you? So there are 3-4 questions on knowing why Union Mutual Fund have not launched sector funds till now, and what is the plan for launching the sector fund?
Yes, I think this has been a difficult decision for us, but our thinking has been that any particular sector fund is good only as a tactical play. That in other words, they run for some time and are not the best options for creating long-term value. And while as Union Mutual Fund, we have been recommending long-term investment in equities for wealth creation, sector funds, in our view, haven't really fitted into that. Now, having said that, we are always open to suggestions. And in recent times, a lot of distributor friends and investors have asked us this question. So we have done 2 things. One is, we have developed a thematic fund, which we think is sustainable in the long term. That's an innovation fund, which we have filed with SEBI for approval. And once we get the approval, provided, valuations are reasonable, we will launch that fund. The reason we are launching, we like that theme, is that it is not a narrow sector fund. It's sufficiently broad-based, and it's a theme that will be, valid for a long time. Because today you have a certain number, type of companies who are innovators and disruptors. You may have whatever. Just to give you an example, you may have a Nykaa, you may have a Zomato or a Policy Bazaar, etc. But 3 years from now, it may, or 5 years from now, it may be a different set of companies, but you will always have innovators and disruptors in the market. So we like that theme, and that's something that you can expect from us fairly soon. Now, specific sector funds as tactical plays, I would say we are evaluating, because ultimately we also have a responsibility to offer to the market what the market needs. So rather than being judgmental, we will evaluate that concept, and if we think we can launch sector funds that create value for investors, we will be happy to look at it. But we will not be the types who will launch a sector fund when it's the flavor of the month and tell everybody to get in, only to see that people lose money after some time. So that's something that we don't like. But if we can handle it in a way where it doesn't destroy value, it creates value, we will look at sector funds.
Thanks, Hadeep. I'll take the next question. Like we share the fair value of Nifty, can we also share the fair value for stocks? I'm sorry, we can't share the fair value stocks for 2 reasons. One, regulatory, we can't talk about stocks. Second is that's a secret recipe. So while Nifty is a dot index, but stock price is something which is a secret recipe, which we keep it to ourselves. There are other questions on the stock. Why we exited from Tata Power in the Union Mid Cap Fund. Sorry, for the compliance reason, we don't get into stock talks of why we entered, why we exit. So Sanjay, going back to you on sectors, if you can give view on IT sector, chemical sector, and aviation sector, and also there's a follow-up question, which sectors are looking good as of now, and if you can also give view on them. Sanjay, over to you.
Sure. So starting with IT, IT has been a large value creator for Indian investors if you look at last decade or two. If you look at even from global context, we have used our democratic dividend and as well as rupee depreciation has also helped these companies to generate a significant economic value for investors over last decade or so. In last 2 years, IT's importance has not only been highlighted by the pandemic, but also the kind of key work which IT systems are doing for each of the businesses, and businesses are getting more and more technologically savvy. It underscores the importance of overall IT in each and every business as such. Indian IT has not only gained market share globally, but also has improved the profitability in last decade as such. That's why Indian IT companies are at the forefront of value creation as such, and that's why view on overall IT has been quite positive for a long period of time. However, recently, post-pandemic, what has happened is that IT companies have rallied quite a bit from valuation perspective. Their valuations run up way ahead of their fair value. And as Vinay had highlighted in past, we might have borrowed some of the returns from future for these kind of companies. And that's why we have changed our stance to underweight IT as such. It's a anti-consensus call by Union AMC as such. But on the long-term perspective, we are quite positive on IT sector. However, tactically, we believe that valuations are quite stretched, and that's the reason tactically we have turned underweight on the IT companies as such. Chemical sector is also an interesting sector from Indian perspective. If you look at last 3 to 4 year journey of this sector, many of the commodity chemical companies have evolved themselves to be a specialty chemical companies. China plus one strategy has helped a lot in getting the business for these chemical companies, and also rupee depreciation is also another tailwind for chemical companies. So some of the chemical companies where we believe these are non-commodity chemical, and where there is a moat of pricing for these companies, we are quite positive on such names, and which feature such kind of names are featuring in our fund house universe as such. And on the aviation, if you look at Indian aviation, so aviation is a very difficult business. If you look at a lot of variables, macroeconomic variables impact this sector, not only oil. These aeroplanes are bought on the lease, so interest rates, etc., impact them a lot. Rupee depreciation impacts them a lot because of the fuel, which is priced in dollars as such. So this is a very difficult sector to operate in, which for investors also globally, this has been a very difficult sector to track. Our view on overall aviation is that if you look at India, aviation in India is quite evolving in nature. There are certain companies which have garnered significant market share in Indian aviation space as such. We are quite positive on these companies. As economic or consumer discretionary spending grows, as economic power of India grows, such kind of companies are likely to show a sustainable profitability and quite a fast growth over a period of time. Particularly, the runway of growth for this company looks to be quite long because of the under-penetration of this mode of transport in Indian market as such. So on the aviation side, there are headwinds because of these macro variables in the near term. However, from long-term perspective, you are quite positive on the Indian aviation sector as such. Did I answer all the points, Saurabh, or was there some subset to the question?
No, you have done. And if you can also cover what sectors we are overweight on and why, what is the view on those sectors? Sure.
So from tactical perspective, we are overweight on financials, consumer discretionary, and industrial sector as such. We believe that we are at the cusp of a capex cycle revival in India. Over a period of time, Indian GDP is also likely to grow at a double-digit clip over a period of time, and that's why we believe that these are the sectors which will be beneficiary over a period of time, and that's why we are tactically overweight this sector. Some of the sectors which we are underweight, which I also highlighted about, is the IT sector, which we have turned tactically underweight on. Apart from that, materials and utilities are the two sectors which are tactically underweight at the moment.
Thanks, Sanjay. Vinay, there are 3-4 questions, and people want to understand how do we calculate a fair value for the stock. So if we can simply, put it in a simple way for all of us.
Yeah. So I think fair value, it's a very simple and intuitive concept, but only thing is it also involves some bit of financial theory. So I'll just give a simple example. Let's say if we have a company which can produce 10 liters of oil, and that's it. This company only has 10 liters of oil which is available. So if you buy this company, you will get 10 liters of oil. So what is the worth of this company? What you will think is 10 liters of oil multiplied by the current price of oil, which I can sell in the market, give it some small discount, 10% discount. That should be the price at which this company should be trading at. This is the fair worth of the company. Instead of, let's say, 10 liters of oil, you change the equation. You say that, this company can produce 10 liters of oil for the next 3 years. And then what you will do is you will calculate that in the next 3 years. Let's say, for example, the price of 1 liter of oil is, let's say, 100 rupees. So every year, this company can produce 10 liters multiplied by 100. So 1,000 rupees worth of oil for 3 years. And in the first year, you generate 1,000 rupees. Next year, you generate 1,000. Third year, you generate 1,000. In the first year, you generate 1,000, and you can invest that in the bank deposit at 5%. So that you calculate as 1,005. Next year, you take this. Once again, you take 1,000, and once again, you decide that you invest it in bank account. 3 years, you once again, third year, you do the same thing, and you aggregate all of that. What happens? You come to a number. At the end of the third year, this is what you will get. Now, instead of the third year, you discount everything up to today. You bring everything to its worth today, which is just take the current interest rates and bring it back by discounting this 3,000 rupees, which let's say comes to, let's say, 2,800. That is the fair value of that company or stock. Companies or the only reason why stock valuation is a little tricky is because of few things. One is most companies will last forever. For example, a company which produces toothpaste, it will forever produce toothpaste, and people will keep on buying toothpaste every year. So there is a stream of cash flows or dividends which this company can generate every year. And the second peculiar aspect about this perpetual bond is that this perpetual bond is growing. So while we have fixed income products which are perpetual in nature, the point is that this perpetual bond also has growing coupons, and this growth can change, which is why equity valuations are very tricky. I won't go into the nitty-gritty of that valuations, but in simple words, equities are perpetually growing annuities. So annuity growing to perpetuity. There are straightforward formulas which are dividends divided by cost of equity minus growth. So that is a simple model to visualize while valuing companies for their fair values. There are certain nitty-gritties, certain valuation related challenges which we as investors and have to resolve while calculating these fair values. And since fair values involve a lot of estimates and assumptions, it is not a precise number. The fair value of a company for me may be 100. For someone else, it may be 150. For someone else, it may be 50 rupees. But from our point of view, the way we compute it, we think that we take into account most of the consensus. And hence, our fair values ideally are very, very broad, and it should not fluctuate materially. They do not have too much of biases, and they are very much grounded in financial theory. And that's the key reason of success of implementing this process in our in our investments. I hope I have answered that question.
Thank you, Vinay. There's a question on BAF, Hardik. So there are times when market corrects very sharply. Do you have an overriding philosophy in BAF that will override the process and do a manual allocation on that day, or we stick with the model? And if we stick with the model, don't we lose out an opportunity which happened last week to do some manual override?
Correct. So no. So first of all, the first answer to the question is no. There is no manual override concept in the BAF model, and that is not there because, simply speaking, historically it has proven that human involvement or emotional involvement in the overall investment process provides suboptimal returns, and that has been proven historically. So even when the BAF was, let's say, at the most peculiar period of time was March 2020, when the allocation was recommended by BAF was to increase the allocation all the way up to 80% when we had just started to work from home. So psychologically, I was thinking that world has changed so drastically, but the allocation was going all the way up to 80%. Even I was emotionally trying to figure out what the model is trying to say and if it's making a mistake. In hindsight, of course, me questioning it sounds a little clumsy because now I have hindsight bias to say that the model did the right thing. So that's why we have kept purposely, we have kept the human involvement, the overriding factor out of it completely. We understand the cases like what has happened in the last 1 week, where one can argue that in one day, maybe the allocation could have gone pretty good and things could have been good. But the model has basically been tested over the last 10 years. Over a long run, it has indicated that keeping this human involvement out of the picture, simply using the fair value as a signal, trying to buy when the markets are attractive, stay away from that when they are expensive, has proven to give good results. So let's not fix something that is not broken yet. And more importantly, I would say that still the jury is out. Markets are volatile. The model is increasing its allocation every day as we use a daily moving average to take into account the Nifty level to make it more stable and not so erratic in its allocation. And the allocation is constantly going up. So I don't think that there is any great opportunity missed. I think we soon will start seeing some cover up on that. So that's the point on what has happened. And just to give one more perspective on this, see the model, again, on a yearly basis, on the short-term basis, it's going to be very tough to judge this kind of an investment strategy. The year ending December 2020, when we were able to capture the bottom of the market, our returns were significantly higher than the category average. So we would not ask investors to look at that and consider that to be the normal. Similarly, this year has been where we have probably not been invested for the whole time when the markets were in a rally, let's say the year ending so far. But on the long run, overall, the model has been able to capture the bottoms and try to capture the peaks also to whatever extent was possible without affecting the standard deviation, that is the volatility in returns. So as I said, again, the model has done its task to the extent that we had already envisaged that it will carry out.
Thanks, Hardik. Vinay, there are 3-4 questions on value versus growth, what to pick right now.
See, I think there is no straightforward answer for value versus growth. So I'll give an example of our calls between IT and financials. So typically, the way people think of value is companies which have low P multiple. According to us, value is companies which are having low price to fair value. So companies which are trading to very close to the current fair value are bargains for us, not value, but bargains. And companies which have a higher growth and because of which they are trading at a premium to their current fair value, these are growth companies. So typically, most of the IT companies fit into the growth segment. And most of the bargains come from sectors like banks and financial services. So we have been very, very positive on IT services sector for the last 2 years. But we have, and we were underweight the banking and financial services for the same period. We have switched our calls on a tactical basis, and we are now overweight banks and we are underweight IT. But there are certain bargain sectors like commodities, like utilities, where we are underweight. And we are overweight sectors like consumer discretionary, which have higher growth. So the way to look at all of this is sectors and companies which give you a better potential return over a 5-year period are sectors where we have to position ourselves, irrespective of whether they are value or growth. Whether we are more positioned in value or towards growth, it is incidental and it is dependent on the potential return. Having said that, generally, as a fund house, generally we have been biased more towards growth because that is an area where we have seen most of the companies which we find are good quality companies, which are having good management and which we think are investable from a portfolio perspective. So generally we are growth biased, but that doesn't mean that we have specific preference right now of one over other. So we are a blend in that sense.
We have covered all the questions. I have a last question for you. With the recent geopolitical risk coming in, we see probably inflation moving up faster and the risk of interest rate moving up, also going up. And in the budget, the government committed to spend on infrastructure. Will the fundraising also come at risk for the government of India? And will it have an impact on GDP growth? Because then it will be impact on fair value also.
Yeah. So yeah, I think clearly there are certain risks to the GDP in the form of higher crude oil prices, because of which the government might have to let go of some of the higher excise duties, or there could be impact on revenue collections, so on and so forth. There can be delay in some of the disinvestment targets. So yes, there could be some fiscal slippages. But I would want to bring your thought towards or highlight this key spotlight on tax collections, especially the indirect taxes. Just excuse me. So the indirect taxes have been extremely buoyant. And the reason is because of better compliance. I think we have all seen how GST has been capturing a lot of inefficiencies. So more and more people are coming in the tax net on the indirect taxes side, and that is helping the GST collections grow faster than GDP. We think that trend will continue, and hence the indirect tax collection clearly will outperform for the government and may help partially offset some of the negative impact on fiscal front because of the current macro environment. So we do not envisage a very significant increase in deficit because of the current environment, and I think that would be more or less manageable by the government. So that's where we are. We don't think so. It will have a material impact on even the spends.
Thank you, Vinay. And thank you, Sanjay, Hardwick, and Pradeep for taking out time. Before I wrap up, I'll give a quick summary of the call. The reason why we did that call was that for last 1.5 years, we have been having valuations where markets were at a premium. In the recent times, with the correction, according to our internal valuation, markets have come very close to the fair value, which also called for a change in our outlook. So if you remember, last 1 year, we have been recommending asset allocation product, which are slightly defensive in nature because of the high premiums. And our view has changed now to get into the equity. However, it is not the time that you put everything into equity in one go. What we are recommending is that you can come in a staggered way for next 3 months, 6 months into equity product. Like we said, based on clients' perception of client risk profile, whether it's a flexi cap fund or a mid cap or small cap. Yes, but the time looks good because markets are closer to the fair value, but also stagger out your investment in the next 3 to 6 months when you're coming into equity fund. In terms of the headwinds, what is working against the market? Yes, we all know geopolitical risk, and we don't know how there are a lot of variables which we are not aware about how it will play out. We are also seeing a risk of inflation moving up, and also because of which the interest rate may move up faster, which has a negative impact on equity valuation. So that's a headwind, which can also have an impact on the GDP growth. But there are tailwinds also, which are working for the market. The valuations have become reasonable, and the capacity utilization can become better in the coming quarters. The low corporate tax rate, which was done 2.5 years back, along with the PLI schemes and all, can have a positive impact on the market. Currently, as a fund house, we are tactically we are overweight on large cap compared to mid cap, small cap, and I say tactically because of the current valuation. And in terms of sectors, we are overweight. And as a fund house, we don't have a top down view. Everything which we have is bottom up. So with a bottom up view, right now, currently we are overweight on financials, telecom, consumer discretionary and industrials, and we are underweight on material, utilities and IT. So this was it from our side. Thank you for joining in the call, and thanks everyone for taking out time.
Thank you.
Thank you.
Bye-bye.
Thank you, everyone. Bye-bye.
Bye.